One final question, Santosh. When you mentioned 2000, around when you started your career, I was a few years before that. We hardly had any money. We didn't have the 500 rupee SIP at that time. We didn't have close to 50 mutual funds. In fact, very few private mutual funds were even around at that time. But yet, when you look back, when you see the last 25-year performance of active funds, many of them have actually delivered more than 20% CAGR during this period. And I think a lot of people from our generation miss that. And, we used to always say that it's the FIIs who came and made money in that growth phase and not the Indian retail investor. And now, of course, things are changing. But my final question, since, you are looking around all the time at companies at different stages of their growth, and probably they will ripen over the next 5, 10, 15 years. Do you believe that an investor who comes in today and stays invested for a long duration, I'm not asking you to predict here what kind of a CAGR can happen, because nobody can predict that. But from what you see happening around you in the universe of companies you are investing in, do you see a strong upside over the next 10, 15, 20 years in some of these good businesses? Of course, some will die also, but there is a fairly large universe of companies who by now that could grow very significantly in the next 10, 15 years.
Definitely. See, firstly, the momentum on the GDP. So what we are looking at is almost double-digit nominal GDP growth. Right? Because really what we need to care about is nominal if you are looking, because we look at returns also. So if we are looking at the nominal GDP growth rate, if it is double-digit, then you're saying that the market is growing at that particular rate. And now, see, what happens in the market is that the themes or the drivers of the GDP keeps on changing. Because what was there in 2000 to 2010 era or 2002 to 2008 era, those are not the same drivers of the GDP in between 2008 to 14 and 14 to 20. And that may not be going forward also. So the new drivers will have multifold growth than the GDP growth itself. So if you are into the right areas, and then that's the job of a fund manager, right? To be into the areas which are going to be the next driver engine to drive growth in the economy. So the underlying growth is very fast. If you are able to be in the right areas, you can be slightly higher or much higher than what the GDP will do over a 10 to 15 year time span. So I think if one is looking at 10 to 15 year lifespan and one is able to sort of follow the process and be firm to the basics, a lot of money can be made through compounding. Only problem is and I keep harping on that always. This is not a place where you sort of buy, sell. If you keep on doing that, you make very, very suboptimal return. And so the returns will be a fraction of what the market will make for you. So if we avoid that particular part of the equation, definitely there is a lot of money to be made in the market.
It's been wonderful speaking to you, Santosh. Thank you very much for taking time out, on a trading day and speaking to our viewers. Thank you very much. I look forward to many more conversations with you. Thank you.
Thanks.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.